This may be the single most important video that I make this entire cycle. Today I'm tearing the entire alt-season thesis down to the studs, with the only question that matters being this: are the fundamental conditions for a violent move up in alts actually in place? And are we headed into an alt season or not? Seeing as I literally have my entire net worth invested into the crypto market, literally even my house I sold and invested into the crypto market, I don't want to just rely on good vibes going into the end of the year, but I want to look at first principles behind what causes alt season and really do a skeptical audit and double check, are those things in place and what are we actually heading into going into 2026. So in this video, we'll go through my exact timeline on how I expect things to play out going into late 2026, which in my opinion, if I end up being right about this, almost nobody is prepared for what is actually going to play out in 2026. We're going to talk about why September is typically bearish, but why this time there's actually a decent chance we end in the green. We're going to do an extensive deep dive on everything that makes up a typical alt season and then compare where we're at to the conditions that were present in 2013, 2017, and 2021. And finally, we're going to bring everything together to update my all-season forecast and see if we're really getting an all-season this time and kind of how we expect that to play out. So let's start with where we currently are in the cycle. Right now on X, there are a lot of people saying that Bitcoin has already topped, that 124K was the top of this cycle, and that is basically down only from here. Those who aren't saying that are saying that we're likely to top around October or November of this year, and that we're, somewhere between there, we're gonna have like a mini little bull run, we're gonna top, and then that's gonna be the end of this cycle. And the really out there fringe ones are saying maybe there's a possibility that actually this cycle extends all the way to January 2026, but at that point, the cycle is going to top and it's going to be over. And pretty much almost nobody is looking beyond that. Nobody is really taking seriously the idea that possibly this cycle could bleed over into late 2026. But those of you guys who watch my videos frequently know that I am actually one of the few people that believe that this is going to be crypto's first 5-year cycle and that we're going to actually top, most likely based on current conditions, at some point late 2026. And this isn't just like my gut feel on like when I think the cycle will top. This is based on the conditions that made up the 2013, 2017, and 2021 alt seasons and bull runs. These were very specific macro environments involving huge bursts in year-over-year liquidity, as you can see on this chart, and involving huge upswings in the business cycle, as you can see on this chart. Alt seasons and crypto bull runs historically have been primarily macro-driven, which is in complete contrast to what most people tell you, which is they tell you that it's halving-driven, which makes absolutely zero sense. This is incredibly easy to disprove because Ethereum went through its own sort of halving when it had the Ethereum merge. And when the Ethereum merge happened, basically Ethereum's issuance, which is the same thing as a halving, was instead of being cut 50% like the Bitcoin halving, was effectively cut over 100% because it became deflationary for a period of time. Despite that massive cut in issuance, the price of Ethereum during that time period did not skyrocket at all. In fact, Ethereum massively underperformed during that time period, which to me was overwhelming evidence that the primary driver of Bitcoin bull runs and alt seasons has nothing to do with the halving, or at least has very, very little to do with the halving. And I have a hard time believing that it's just pure coincidence that the absolutely insane bull runs we had in 2013, 2017, and 2021 just happened to coincide with really prosperous macroeconomic conditions like that huge growth in year-over-year liquidity and like these huge spikes up in the ISM business cycle. And if you believe this, that the alt seasons of the past and the bull runs of the past were not primarily halving driven, so they're not just like, magically time-based, but they're actually fundamentally driven by macroeconomic conditions, there's actually a really good and easy way to measure when we should see the next alt season and when we should see the next insane crypto bull run. And that's by basically breaking all of these things down to their studs, measuring where they're at, where they're headed, and then looking, ahead at where they're likely to be based on policy decisions by the Trump administration and globally. And I promise I'll try to make this the least technical that I can and simplify this as much as I can. But we are going to get a little bit into the weeds on these things because I'm primarily making this video for myself because, again, I am heavily exposed to crypto. And I want to know if I'm like heading into just an absolute slaughter machine and I'm about to lose all my money, or if I really am set up for this massive move up in alts. Okay, so let's go through the different macro elements that make up an alt season and make up a crypto bull run. The first one we've already talked about, and that's a huge burst in liquidity or a huge liquidity impulse in terms of year-over-year growth. The second piece would be the price of money or real yield. The third would be risk transmission. Can basically the economy and the financial system handle these flows, or is it at risk of breaking? Are people worried? Or are they nervous, etc.? The fourth would be the growth pulse, or basically the way that I measure that would be the ISM chart. Is the economy heating up, or is the economy slowing down? The fifth would be policy glide path. Is the Fed heading into raising rates? Is the Fed heading into cutting rates? Are they doing QT? Are they heading towards QE? All of those different things. The sixth would be market structure, and this is less of a cause of alt season in a bull run and more of an amplifier on the way up and on the way down. I'll get into like what that is and how it works in a second. In the seventh is probably one of the most important, and that's narrative or the direction of money. Like how much interest is there in actually investing into crypto, altcoins, etc.? How hyped is the narrative? If you have a hyped enough narrative, even with bad macro conditions, you can pull more money or more liquidity into the market because investors are just, clamoring, hand over foot to get into that market. And maybe the best example would be something like AI. Even at the depths of the bear market, AI was seeing like billions and billions pour into it because, the narrative was so strong. Even though macro conditions maybe weren't the best, the narrative was able to overtake those macro conditions and still suck all that liquidity out of everything else. And if you actually look at these 7 different dials back in 2013, 2017, and 2021, you can see that things actually do line up pretty well. Then in 2013, you had a strong liquidity impulse. The price of money was neutral. The risk transmission was neutral. The growth pulse was looking great. The policy glide path was looking great. The market structure was neutral, and the narrative was looking great. In 2017, it was even better. The price of money and the risk transmission were both sitting in the green. The growth pulse was actually sitting in the purple, which is like green on steroids. Policy glide path was sitting neutral, so it wasn't quite as good. But market structure and narrative were both sitting pretty hot, meaning overall it was a pretty awesome environment for an alt season and a pretty awesome environment for a crypto bull run. And obviously 2021 was just absolutely unhinged. Everything was basically pushed to the max. This ivory color means basically it's in overdrive, and you can see that all of these things were basically either in overdrive or just on steroids in terms of where they were positioned. Basically, during all 3 of those periods, you can see that the 7 dials that I'm talking about all lined up is extremely bullish. However, if you take a look at the past couple years from 2022 up until today, 2025, you can see conditions have been dramatically different. For example, in 2022, it was just absolutely abysmal. The dark dot basically represents an extreme headwind, and you can see that most of the metrics were in like deep black. We did have growth pulse sitting in the red, which is also just horrible. And then the best one, which was like warming up but still bad, was the narrative. In 2023, things did improve, and we noticed that in prices. 2023 was actually a pretty great year for crypto assets, but it was still pretty abysmal in terms of these 7 dials. The best one was narrative. That was doing pretty good, but everything else was either sitting at neutral or at headwind or at warming but still bad. 2024, things slightly improved. Market structure, because those ETFs flipped extremely bullish. The policy glide path, because we got that rate cut in September, flipped neutral. And this green one, the narrative one, flipped to purple because some of the narratives around ETFs and TradFi getting involved in crypto, and then Trump getting elected and some of his promises on the campaign trail around crypto, all these things flipped narrative extremely bullish. But in general, it looks nothing like what we were seeing in 2017, 2013, and 2021. And this is today, year-to-date 2025. And you can see things have still continued to improve. And we've seen the continued growth and acceleration of narrative, which is currently sitting somewhere between purple and in overdrive right now, which when you add up the Clarity Act, the altcoin ETFs, the just record-breaking pace of the Bitcoin and Ethereum ETFs. And if you remember when the Ethereum ETF first came out, people said it was going to be a dud. It kind of was a dud when it first came out, but now it's actually outpacing the Bitcoin ETF. So these things are just continuing to accelerate. All of these things like the SEC flipping pro crypto, the Genius Act getting passed in Congress, Circle's IPO just going absolutely bananas. All of these things really add up to an environment where like the narrative around crypto has really kind of kicked into that overdrive mode and is continuing to accelerate year over year. But even still, if you compare 2025 to any of these years, 2013, 2017, and 2021, it looks dramatically different than the environment of these 7 dials in any of those 3 years. In fact, this is what 2012, 2016, and 2020 pre-COVID looked like in terms of setups. And you can see this is a lot more similar to what we're seeing in 2025. A lot of neutral, some green, some red. And with 2012 and 2016 both having kind of one overpowered one similar to 2025. So the question is, what are we heading into in 2026? And are these conditions likely to change for the better, or are they likely to actually get worse going into 2026, which is what historically has played out after 2013, 2017, and 2021. And you can see that most clearly with 2022, like basically sitting all in the black. Like it was just a really, really bad year. And in retrospect, it was really easy to see if you were looking at these 7 dials that 2022 was going to be a horrible year for crypto, because those 7 dials had flipped from like extreme, it's time to buy, it's time to go, really supportive environment, to extremely negative. And literally all I do most of the time is try to figure out how this is going to play out into 2026. I spend a ridiculous amount of time going through all of these conditions and kind of where we're headed. I listen to a lot of podcasts. I read a lot of books. I listened to a lot of snippets from Scott Bessent and Trump spelling out exactly what they're planning on doing going into 2026. And it does paint a pretty clear picture on where we're headed. First off, we'll talk about the single most obvious thing that I think most people are paying attention to, and that's rate cuts and the Fed. I think by now, most people are aware that Trump is wanting like something insane, like 300 basis points of rate cuts. And he's very, very determined to get those rate cuts. So much so that he has been like heckling Jerome Powell, calling him all sorts of names. He showed up to the Fed, did this whole tour. He's like questioning like how much money they're spending on a building they're building. He's trying to get Powell to quit, trying to get Powell to cut rates. He just went and fired Governor Lisa Cook based on this whole, like, it's like a mortgage fraud thing or something like that. We're not going to get into all the specific details of these things. I think the really big takeaway is that Trump is very, very determined to get rate cuts, and he's going to do whatever it takes to get those rate cuts. And basically, so far, his moves have showed us that his intent is to stack the Fed board so that it's in favor of like more dovish members. That just means members that are more likely to cut. And we know for a fact next year in spring, Jerome Powell is out. Like he is going to be out of the Fed chair position. Trump gets to nominate a new person to that Fed chair position. And it's likely going to be somebody who's going to do what Trump wants, somebody who's very malleable to cutting rates. But it actually takes a little bit more than that to get rate cuts. That the Fed chair doesn't have like supreme power over the Fed. There are 7 Fed governors and there are 5 regional presidents. One of those presidents is permanent until they retire. The other 4 rotate annually. And the Fed governors get a say in a veto power in who gets to join that batch of like rotating members. And so part of what it seems like Trump's plan is to stack the Fed governors so that they only accept into that batch more dovish members, members who are more malleable to cutting rates. And that between the Fed governors, the Fed chair, and between those regional banks, they could get a majority share of dovish members who are more likely to align with Trump's plans for running the economy hot, loosening credit, and cutting rates. And I've said before, basically, this one comes down to, if you're trying to predict the future, do you believe Trump is going to ultimately get his way with this, or do you believe he's not going to? Trump for sure gets to appoint the next Fed chair. They carry a huge amount of weight and power in the way that these discussions go. That is just already on its own overpowered. He also gets to appoint multiple other Fed governors. That's also overpowered on its own. And there's no really, it's not like he has to go fire people to do that. But also, if he gets away with being able to fire Lisa Cook, then at that point, it really is game over. He's going to fire whoever he wants to fire, get them out of the Fed, and appoint who he wants to appoint. And even if that doesn't end up working out, like, he's going to get creative. He's going to find a way to stack the Fed board in his favor, and he's going to get these cuts. And in terms of what 2026 would look like if we got 2 cuts this year and 3 to 4 cuts next year based on Trump stacking the Fed, we would see a lot of these dots flip from yellow or red to either green or purple, looking something closer to like this in 2026. Now, on top of this, we have some really clear catalysts next year in terms of narrative that would keep the narrative in the overdrive phase. The first one is come October of this year, we have a range of altcoin ETFs that are up for approval. And according to Bloomberg, the odds for these ETFs are currently sitting at around 90% odds of being approved. Bloomberg has a pretty decent track record with getting these things right. And that does line up with the current stance of the SEC, which is flipped from extremely bearish in anti-crypto to extremely supportive in bullish crypto. It's so much so that Paul Atkins came out and said that he wants to update our financial system and bring it on chain, which is like nothing you would have heard out of the mouth of the previous SEC administration. So I think that's about right, that we currently are sitting at around 90% odds that we get those ETFs approved. The SEC has also talked about standardizing this process so that for future altcoins, it's just a really easy process to know if you can get approved or not. If we get things like XRP and Dogecoin ETF, which those ones are currently sitting at 90% odds of approval, if we get those things approved, then it's pretty much just like open season for almost any altcoin to get an ETF. And very likely you're going to see a range of other altcoins get ETFs in 2026. That's going to massively expand that market structure category where now altcoins, specifically altcoins, will be really easy to access for the majority of market participants, and could likely even flip this one into the overdrive category. And the reason I say that isn't because I think like institutions are going to go buy these altcoin ETFs. It's because I think retail is going to buy these altcoin ETFs. As of right now, roughly 85 to 95% of the inflows into the Bitcoin and Ethereum ETFs are retail. It's actually not institutions. It's almost entirely retail buyers of these ETFs. And a huge portion of this is via financial advisors. So you have your mom and pop investors, retail investors who are investing via a financial advisor who now can access and recommend these things to their clients. And so they're going and saying, hey, do you want to allocate a little bit into this Bitcoin ETF, into this Ethereum ETF? This is something they couldn't do before. And so you're seeing these huge inflows into like literally record breaking into the Bitcoin and Ethereum ETFs. And it's primarily being driven by these retail investors, which with that being the case, when these altcoin ETFs come out, why would we think anything differently? If this is primarily being driven by retail investors, well, when they can get their hands on these altcoin ETFs, it's very likely they're going to invest or allocate some of their capital into those things as well. And when those altcoin ETFs do extremely well, that's just going to motivate the next batch to launch altcoin ETFs, and then the next, and the next, and the next. And there's going to be endless speculation on what altcoins are going to launch ETFs, and with the answer being that any altcoin that can launch an ETF is likely going to launch an ETF. On top of that, we have the Clarity Act, which should be approved next year. It's very likely that is going to get approved at some point early next year, which is going to also just be a massive narrative catalyst, a lot bigger than the Genius Act, because this is like full on giving rules of the road when it comes to crypto, digital assets, etc., and creates a lot more room for innovation and different companies to come to the table and start getting involved in the space and get involved investing in the space. It's like a huge legitimizing effect on the space, and specifically on altcoins. Again, there's a lot of this really emphasized altcoins, like Bitcoin's safe from all this stuff. Like nobody's even worrying about this stuff. This really has to do with altcoins. And here's something crazy. In traditional like equities, 36% of the holders are retail, while institutions hold the majority at 64%. When it comes to Bitcoin, retail holds 72%, where institutions only hold 28%. So it's like the exact opposite. Retail holds the majority and institutions don't, which is not normal. It's very much more normal for institutions to hold the majority. It's just institutions have really not even started dipping their toes into this. I guess you could say they started dipping their toes. But they have not really gotten the ability to fully allocate into this space the way that they want to. It just takes a lot of time. I've been saying this for the last couple of years. They're slowly going through their due diligence process to allocate into the space, and it's going to take some time. But this is like a never-ending stream. This is just going to continue to ramp up over time, where they're going to be buying more and more Bitcoin. And when this really starts taking off, it's going to get out of control. Because right now, as I said, they hold the minority of assets. But by the end, they will hold the majority when it comes to these assets. Because the institutional capital is just so much bigger than the retail capital. And when it comes to the broader altcoin space, like when it comes to altcoins in general, it is like vastly more skewed. It's probably something like 97% of buyers. I almost want to say 99%, but I'll go 97% of buyers are likely retail when it comes to altcoins, with just like 3% being some form of institutions. And again, that even feels super like too much. It should probably be 99% are retail and 1% are institutions. But I don't expect it to stay that way. I actually think institutions are clamoring at the bits. I don't know if I'm even saying that right, to get into some of these altcoins. Think about the fact that like hype is the single most profitable company on the planet per employee. Their revenue per employee is around $110 million. They make around $1.2 billion annually per year with an extremely tiny team. Or think of something like Tether, which in 2024 had a net profit of around $13 billion. Compare that to something like BlackRock, which in 2024 had a net profit of around $6.37 million. Tether, a crypto company, was able to make literally over double what BlackRock made in 2024. Or think of something like Pump.Fund, which was the fastest company on the planet to reach $100 million. They did it in 7 months and 7 days. My point is there are really investable protocols in the crypto space that absolutely institutions are going to want access to. Obviously, the vast majority of tokens, probably 99.9% of tokens, which are just absolute nonsense, they're not going to want to invest into those. But there's definitely going to be a subset of protocols that the institutions are going to want to invest into. They are going to want access to. In the future, the majority of altcoin holders will be institutions. It's going to be a much smaller subset of altcoins. It's not going to be all altcoins. It's just going to be those highly investable ones. But still, I expect institutional involvement only to accelerate over the coming decade when it comes to altcoins as well. All right, we're going to accelerate through these different building blocks because I have a lot to get through. We're going to start next with tariffs. Currently, tariffs are mostly priced in. I do expect that if tariffs continue at their current rates, we will likely see some sort of push up in inflation going into 2026. It won't be across the board, but you will definitely see certain categories or sectors probably hit with a one-time boost in inflation. To kind of pour some water on everything I've been saying, inflation is the one kind of world-ending event that could stop everything from happening. Like if inflation gets out of control, all of this is over. The policy response to inflation is basically to crush the market, and it's something that we don't want to see. And when it comes to specifically tariff inflation, my gut take is in 2026, it'll probably be fine. There's basically 3 ways for inflation to get absorbed. Either the manufacturer can absorb it, the consumer can absorb it, or it's like a mix between those two. It's probably going to be a mix between those two. One thing I think a lot of people forget is consumers directionally can affect this. So like if, the price of eggs goes up too much, people just end up buying less eggs. Or if the price of beef right now is gone up because of this historic cattle shortage, people are going to just buy less beef. They're going to buy more chicken, they're going to buy more pork or whatever. So there's a lot of different ways to kind of smooth this out and make it not as big of a deal as something like what we saw in 2021, which was hugely driven by like this shipping backup, right? Like we had all these shipping backups that across the board just pumped the prices of everything, which we're not having that same issue today, which means that things should relatively stay in control, at least over the course of 2026, and at least when it comes to these tariffs. Now, on the other end of the spectrum right now, that you did have these courts come in and say that the Trump tariffs are illegal and that they have to be repealed and all this kind of stuff, likely going to end up at the Supreme Court, and they're going to kind of have to hash out if it is illegal or if it isn't. There's really nothing to worry about that when it comes to the markets. Really, if Trump tariffs are declared illegal and they have to reverse them, that's only good for the markets. That means all these inflation worries go away. The Fed's excuse of like, we're worried about tariffs, that goes away. So they can just cut into oblivion. In terms of the markets, that's only upside. So there's nothing to worry about in terms of that. In 2026, we also have the midterms. And I think this is more on the policy response side, a huge catalyst in terms of motivating Trump to want to follow through and run the economy hot. That's already been his plan. He wants to run the economy hot in 2026. But now you can see he has also a solid motivation for why he should want to run the economy hot in 2026 and not push it back to 2027. And that's because the midterms are in 2026. And so if he wants to maintain his control, he's going to have to make sure things go really well for the Republicans in 2026. And one of the best ways to do that is to make sure the economy is doing good in 2026. And so just kind of think that of that as like an overarching theme in 2026 is that those elections are looming. Trump's entire legacy and plans depends on those midterms going well for him. And one of the best and easiest ways to do that is just make people feel rich, make people feel good in 2026. And they're going to want more of that. They're going to vote for more of that. But if the economy is really doing poorly in 2026, that's not going to be very good for Trump and the Republicans. And they're not going to want to have that happen. And they control the policy levers. They're the ones that get to decide, do we turn on the money flow or do we turn off the money flow? And so there's a lot of incentive for them to want that money flow to go really well into 2026. After that, we had the ESLR, or the Enhanced Supplementary Leverage Ratio. Basically, the SLR was put into place after the 2008 financial crisis to make sure banks had like a backstop of reserves so that we didn't have to go through something similar in the future. What they've kind of found over the last decade is that maybe there was a little bit of an overreaction when it came to SLR requirements that have really kind of tied the hands behind banks' backs making it really hard for them to lend and really restricting their ability to do what the government wants, which is to buy more treasuries. Because if you only have so much reserves to use, that kind of crowds out the bank's ability to buy treasuries. So the enhanced supplementary leverage ratio is actually a genius response by the Trump administration to try to free up credit, get more lending going. That'll make the economy run hot because lending is a form of money creation. But also on top of that, that should bring the 10-year and the 30-year rates down because banks are going to at least meaningfully have some sort of impact because that's going to allow more banks to hold more treasuries. So I think there's a really, really good chance this ends up getting pushed through because it's just something that makes a lot of sense for the Trump administration to want to push through. Scott Bessent has talked about it over and over and over again. I think this is something that goes through likely into this year, early next year. And this is maybe what we could see if the ESLR goes through in terms of these 7 dials. You can see actually most of them get kicked into tailwind on steroids with narrative obviously still sitting in overdrive. And this is obviously coupled with getting those rate cuts as well. Now, going back to institutions and why they don't hold more crypto today, but why they're likely to start holding more crypto going to 2026, a lot of what's holding them back has been a lot of these policy and regulations put in place by the previous administration, the previous SEC. And as you guys know, Trump has been just on a tear, dismantling a lot of these things. So the SEC has completely flipped their stance. And so it takes time for these policy responses to form, to get, actually put into law, all this kind of stuff. But we've been doing that since Trump came into office. Like this has been moving slowly over the course of the last year. And some of these huge things that have been holding back institutions from buying into the markets have been repealed and pushed out of the way. And so as we go into late 2025 and into 2026, I expect that institutions are going to start dipping their toe even further into the space because now legally they're able to do that. For example, the SEC rescinded SAB 121 at the start of this year. We have the new Genius bill that came through. The plumbing's going to take a little bit of time, but that is law now. And so that opens up a whole new playing field when it comes to institutions. A lot of the reputation and fiduciary risks that were put into place over the previous years are being unwound. There was a lot of heat from the government and all these organizations if you did anything in the past with crypto. They would look really closely at you. They'd be like, what are you doing? Why are you dealing with that terrorist drug money kind of stuff? Where all that's flipped, like that reputational and fiduciary risk has flipped, but obviously it's just warming. They're just getting used to this new environment. And it takes a lot of time for these legacy institutions to really, they're not like quick risk takers. They do these things really slowly over time. And so as you see that environment continue to warm, you're going to see more and more of them jumping into the space. And so right now you have a lot of like toe dipping and kind of like pilot programs that are in place as of 2025. Next year, you're going to start to see meaningful allocations in the space over the course of 2026, which should also be a huge driver of price appreciation across Bitcoin and ETH, which should further drive price appreciation across altcoins as well. Now, oil or the cost of energy is baked into inflation. And so it going meaningfully up or down is actually a really important and critical factor in terms of inflation, which is our number one enemy when it comes to this bull run. And so that's something I've been keeping a really close eye on. As of right now, when it comes to expectations and predictions, there's expected to be like a surplus going into 2026 of oil. It's likely we kind of stay in sort of like a chop neutral band over the course of the year, unless we have some sort of war or some sort of catalyst shock that hits the market. But I think one thing maybe less people are accounting for is the fact that if the Ukraine-Russian war were to end, it's very likely that we would start to see Russian oil re-enter the global economy, which would further put pressure on oil prices and push those even lower, which would be extremely bullish when it comes to inflation, but by reducing the cost of literally everything. When the price of oil goes down, that reduces the cost of like foundationally almost everything. So that's actually a tailwind that could go into effect in 2026 if we're able to get that peace deal. Now, outside of this, I recently heard a really interesting take that I actually really liked, and that was on housing equity. And so if you guys saw this past week, Trump declared or said that in the fall he's maybe going to declare a national emergency when it comes to housing. Obviously, housing is a really, really big deal when it comes to my generation and below, because a lot of people can't afford houses. And so one of the things that I've heard floated, and I don't know where they pulled this from, but it sounds like something that's very plausible and that would be extremely, extremely bullish, is the idea that currently there's around $11 trillion in home equity sitting in the U.S. And really, the problem is how do you tap into that home equity? And this comes down to things like bank lending, et cetera, and the rates that are set around that. And so if they were to strategically push that direction on how can we tap into that 11 trillion of home equity, so basically allowing people to take out loans against their homes at pretty decent rates, that would be a really great way to run the economy hot, get things going, because it unlocks literally, $11 trillion worth of value. I'm sure, obviously not all that's going to get taken out, but it unlocks a huge amount of liquidity in the economy that would really heat up things and get things going. Now, I know one of the big concerns that people have, and this is a concern that obviously it makes sense, is that currently the stock market is sitting at historic highs. Like it's like the valuations have disconnected so much from the actual stock prices that a lot of people are concerned that we're headed for like an imminent market crash. And one of the reasons I actually don't think that's going to happen is not only all these macro things that I've just laid out that are just a prime environment for assets to go a lot higher, but another one comes up from this concept called a crack up boom cycle. And the idea is vaguely, because I'm just kind of vaguely leaning into that concept, that asset prices basically disconnect from reality because people need a place to put their money. And you can really see this, I think, in gold right now, where gold is just hitting historic highs while bond prices are really faltering right now. And basically the idea is that like people are starting to catch on that the government has no way to get out of this debt situation. And the only response they have is to inflate away the debt. And it's not like they like fully understand that. It's just like they're vaguely aware of inflation now. They're vaguely aware that like bonds and all these things are not as valuable as maybe they had previously thought. And so people are looking for a place to store their wealth more and more. And the place to do that is in assets. So you're seeing like this kind of like infinite bid for assets over time because people have to put their money somewhere. And in leaving it in cash, it really isn't an option. And so I think it's possible you see almost this disconnect from reality when it comes to asset prices, as more and more people become aware of like this idea of like the only response that we have is to inflate away this debt. And if you don't own assets, you're just literally going to get left behind. And just kind of one more chart to show you what it would look like if we got that Russian peace deal and oil prices were to drop. You can see a lot of these things actually flip into overdrive. I think this is probably overestimating the reaction because in reality, markets are a lot more messy. I don't know that it's necessarily going to look like this. But also, I'm not accounting for, this is just with those 3 different updates. There's a lot more levers and things that are coming, like the Trump stimmy checks. I'd say it's probably just a 50-50 shot. But if we were to get Trump stimmy checks based off the tariffs, which is a genius political move, and I could see why they would be incentivized, especially going to midterms, to want to do that. That would push these things even higher. You have the Trump 401k executive order, and that's going to kind of accelerate going into 2026. It's likely that the Fed ends QT at some point either this year or early 2026. There's just a lot of other creative financial engineering that the Treasury, Scott Bessent, and Trump can do to really get things into overdrive that could also play into this. And then there's the fact that this is, I'm mostly focused on the US. There's also Europe and China, and Europe's like more ready to spend and like take on debt than they ever have been before. A lot of this comes from the fact that like Trump's been like, hey, we're not going to defend you in the same way we have before. And even just having that happen once, they're like, oh my gosh, like we probably should have our own military and we probably should protect ourselves a little bit more. And the only way to do that is through debt. You got to take on some debt. You got to finance those things, get their economies running hot. And then you kind of have this AI space race going on where like everyone knows AI is like going to be this massive thing. Everyone's competing to be the next big AI and robotics, the next big AI and robotics epicenter of the world. So, everyone kind of wants to run everything hot. To get these things going. And so you're just seeing a lot more spending, a lot more countries taking on debt, and just a lot more freeing up of credit on a global scale. And so all of these things play into this. And so I guess I'm trying to point out the fact that like there is a path to this running like really, really hot, like not just kind of hot, not just 2013, not just 2017, but something maybe even like not exactly 2021, obviously, because that was just unprecedented, but something pretty major, like something really, really juiced up in 2026 that I think just a lot of people are not accounting for even the possibility. And it's not like going to be disappointed if it's just like 2017 or just like 2013. Like obviously, bull run all season is going to be great. 2017 was awesome. I was a part of that cycle. It was amazing. We did really, really well. But even the possibility, even if you put it at like 10%, 20% chance that we could have something even remotely in the league of 2021 is insane. That actually is insane. And if you talk about narrative, you talk about stable coins and like market structure and just like regulations, et cetera, everything far in that category far exceeds anything in 2021. Like we are so far beyond that. It's not even close. If you talk about institutional adoption, everything in that category far exceeds anything like what we saw in 2021. And so I think there's actually a really, really credible path that we could, be somewhere around there if all the cards get laid out the way that we hope to and expect them to get laid out. And if some of you guys are like a little bit worried about the ETF thing, I mentioned earlier this like primarily being retail driven. Some of you guys are worried about that, like, oh my gosh, retail must be tapped. I've actually heard this take on X or a podcast or something that like retail's almost tapped out. We need institutional demand to come on. That isn't even remotely true. Like, not even remotely true. That is like such a stupid take. It's like insanely stupid. Most of the retail demand that we've seen so far has been like millennials and below buying crypto. Okay. Like the poorest generations have been buying crypto. And that's been where you've seen a lot of this like uptick in demand in crypto. The boomers and like the older generation who control the vast majority of the wealth have not been touching this stuff. And kind of my gut take is probably a lot of these ETF flows are those boomers finally getting to like Bitcoin and Ethereum, right? They're finally putting a little bit, like they're like, oh, I'll put in like 1% or 0.5% into, allocated into these things. And so that's where you're seeing this new retail demand. It's just like a really small unlock of this like boomer generation money. And I think that's going to actually continue to accelerate as we get more ETF products and they get a taste for these gains because they're just people like anyone else. Where they get a taste for the gains. They don't have to custody the crypto. They're going to be holding it. Their financial advisors like, you want to hold more? You want to hold more? And they're going to be just kind of upping that. But on top of that, like they're going to also die at some point. And when they die, that money's going to get inherited by the younger generation and they're going to do that even more so. And so you're going to just continue to see this structured bid in the ETFs and just in crypto over the next decade from these things. And that's not going away anytime soon. And on top of that, like TradFi is like now the marketing engine. Like these institutions, they might not be onboarding their own capital yet. They're going to, but they're productizing crypto like mad. They're like building all these crypto productization to sell to these boomers and all these other people so that they can make money. But on top of that, they're just marketing it like crazy and they're doing a really good job. Like Tom Lee's on CNBC like every freaking day, promoting ETH and telling everyone to buy ETH. And, there's all the Bitcoin guys promoting Bitcoin, telling them to buy Bitcoin. Altcoin ETFs go live. You're going to have all these other guys promoting their altcoin ETFs and telling them to buy that. And they're going to listen. Like boomers, they listen to the people on the news that tell them what to do. Okay. And so they're going to be buying more and more of this stuff. And that's going to vastly accelerate going into 2026. And so here is kind of how I'm mapping out the next couple months going into 2026. Obviously, I'm not a wizard. I can't predict what's going to happen, but this is kind of my gut take on how I think things are likely to map out. As far as September, the outcome is kind of unclear. My gut take is that we actually end green, even though consensus is it's going to be deep red. And even my initial take a couple months ago is that September would be bearish because of the TGA rebuild. But everyone else is so bearish that I'm kind of starting to feel a little bit bullish. And also, we pulled forward so much pain in August that I just kind of feel like it's likely we end in the green in September. So I think we started the month at like 107, 108, somewhere around there. I think we end it higher than that, especially if we get the rate cuts. I think it's probably a pretty good month overall. Although obviously, if there's going to be pain, it's going to be over these next 2 weeks. So you're going to watch this video. There might be pain over the next 2 weeks. If it's going to happen, it's going to be then. And so don't let that just like disillusion you. And I'm not saying for sure. That's why I'm saying it's kind of unclear. But like loose gut take is probably into the green. October is seasonally bullish. The TGA rebuild is going to be gone. We're going to have all these altcoin ETFs. And so I think October is going to be just epic as always. Probably a lot of the gains are going to be loaded in the second half of October as things really start to accelerate. November, I think, is going to also be bullish. December, I don't know. Unclear. I kind of lean bullish, but I'm not sure. I think January is probably the first potential pivot point for when we see kind of a pretty decent dip in retracement and just really big scare in the market. It's probably going to be the point where most people are going to be like telling you the cycle's over. I told you. They're going to make some big long posts. You're going to see big long videos. Everyone's going to be like really gloating that they know the cycle's over and you're an idiot for holding and all this kind of stuff because that's what they're used to. It's happened every 4 years up until this point. They're used to the pattern. That's all they're leaning on is the typical 4-year cycle pattern. And it's going to be a big scare moment when that happens. January kind of feels right. I don't know. Maybe it's February. Maybe it's March. I don't know for sure. But like January sometimes is like a pretty bearish month. And so I think there's at least a decent chance that that's the time. After that, though, people are going to realize that Powell's out of office in May and we're going to get all these rate cuts. And so you're going to start to see the market tick back up. And, there a lot of these people that sold are going to be really disillusioned saying it's not going to go higher. And then when it really does, I think they're going to actually lose their minds and be like, what the frick is happening? And then they're going to start, they're going to have to buy back higher, and it's going to be just a whole mess, craziness. And I think this is probably going to be where everyone becomes, oh my gosh, the 4-year cycle is broken, they're disillusioned. And then you're going to start hearing people say that, like, because of ETFs and TradFi and institutions, we're never going lower. Like, this is just always going to go up. And people are going to get into this up-only mentality that's really going to be pulling in a lot of leverage and a lot of momentum into the market, which is going to cause, is the recipe for that parabolic run-up later in the year. And then alongside the rate cuts, you also have the Clarity Act, and then more ETFs coming online. And then, maybe we have some like kind of downer months that are kind of like light down, light up. I don't know. But probably June, July, things start kind of really picking back up again. August, September is just seasonally bearish. So it's kind of hard for me to be bullish on those months. So I guess I'll say that, maybe those are kind of better light as far as things go. And then October through December, probably October or November, is when we have that crazy blow off top. Things get out of control. People are telling you it's never going to end. And then just structurally, because you get all this leverage and just unhealthy behavior entering the price, you're going to have a huge retracement as all of that kind of gets siphoned out. And so probably, and just like when you run the economy hot, like things just get out of control. So, we'll have a clearer picture once we get there, but it's just very likely that if you run it hot, you're going to have to like kind of pull back a bit in 2027. And so, it's very likely that kind of marks the top until we start a new cycle at some point in 2027. Okay, so there's just an insane amount of evidence in favor of 2026 being extremely bullish. But what about the evidence to the contrary? Like, what tells us that maybe it's going to be bearish, or like what should we be worried about? I already mentioned inflation. But I think outside of inflation, there is definitely this potential scenario where we don't get a rate cut in September. Currently, it's priced in at 90% odds. So like that's a small, very slim chance. But I think those odds could dip quite a bit if next week, I believe it's next week, we get the CPI and PPI readings. And if they were like extremely bad, I think that would bring those odds down significantly. So it could turn on literally those prints. And that would be what worries me. If those come through clean, then it's probably smooth sailing. Actually, probably at that point, if it comes in clean or bullish, it's probably up only from that point. I would say like pretty decent, like maybe 80%, 70%, 80% chance at that point it's up only, because people are going to really start pricing in those cuts. But let's say we don't get a cut. Let's say for some reason something happens and we don't get a cut in September. Low odds, but let's say it. How do things play out then? I think it's probably pretty brutal. We definitely end in the red in September at that point. Maybe we get a cut because of that, because there's such an expectation for cuts, and because we don't get the cut, stock market, all this kind of stuff starts dropping. Something starts unwinding or breaking. There's now a bit more of a potential for a cut in October, November, as the Fed kind of pivots back, because like it's kind of self-fulfilling prophecy. You don't cut, economy's going to do poorly, then you got to cut. Especially when it's so hyped, right? So it's such an expectation. But let's say even that doesn't happen. Then I think, maybe it's a little bit brutal, a little bit tougher. I still think we kind of pick up late October though. And like we just go really far down, cleanse everything. And then, we have a lot more to go, more upside. So like from the bottom, wherever we end, to wherever we go in October, it's just like a lot of gains in terms of upside from that point. And then I think people start looking ahead at like towards 2026. They start looking ahead towards Clarity Act and the rate cuts and all that kind of stuff. And then they start pricing that in, which kind of pulls things for, it's more of a slow grind into 2026, but I think that pulls things forward into 2026. Overall though, kind of bringing everything together and like looking at the full picture. I feel like I've tried to summarize it in this video well. I just think this video would probably be too long if I guess I went into every detail. But behind the scenes, as I was putting together this video, doing all this research, like I put in a lot of work to really go through the details of like, where were things, where are things going? I think it's very, very clear that this picture is insanely bullish. And I feel very comfortable holding my entire net worth in crypto right now, because I think the upside potential is absolutely unhinged. Obviously, just because macro environment is really bullish doesn't mean alts will for sure go up. That's where you need that narrative plus catalyst. But I think we have the narrative. Like people are more bullish on crypto than ever. And I think the catalyst, altcoin ETFs, rate cuts, and Clarity Act, all these things are like all potential like jump starts for the market. And once it starts going and it's got that fuel, I don't see why it, I see it keep continuing on, retail jumping on board, and these things really working out. And if I'm wrong, I'm going to lose a lot of money. Like I just straight up, I will lose a fortune if I'm wrong about this. But if I'm right, I'm going to make a fortune. And I put in a lot of work, a lot of research, a lot of my homework has been done. And I'm really happy with the current shape of things, the current odds. I feel like the odds are heavily in my favor. We'll see how these things play out. If something crazy happens, I'll obviously do an update. But yeah, it's kind of like a final flight check. Things are looking good. Things are looking as expected. They're looking extremely bullish. And I'm excited to see how things play out in 2026. And if you want to see weekly video market updates on all these kind of things, I do that every single week in the Obsidian Council, as well as I post anytime I buy, anytime I sell, share my entire portfolio and a bunch of other things. Currently, the Obsidian Council is closed to new members, but if you're interested in joining the waitlist, there's a link in the description of this video. As always, if this video is helpful, make sure to hit that like button. If you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.